Welcome everyone back to Pete's Investing Updates. In this strategy edition, we're talking about the simple blue chip trading strategy using CCI. And in this video, we're comparing that against the MACD variation. First, always don't forget to review the indices playlist, the share price, blue chip share playlist, and also our strategy playlist. That's where we cover the simple trading strategy, the average down process, and some money management ideas. We're not offering financial advice, it's simply an educational video series. Some things to consider: we track and trade on a daily chart since we want to back test and see results of trades back during the GFC as well as the COVID effects. We track and back test revenue over drawdown requirements as a percentage to optimize our returns with less exposure. Brokerage is included in our back testing. I use $8 per transaction each time we buy or sell, and revenue show may change slightly depending on your brokerage costs. And our back testing transacts with $2,000 per trade. That is every time you purchase $2,000 worth of shares in the instrument you want to invest in. So let's get started. Very simply, I want to explain the strategies we're following. So this is the price chart, obviously, and this is our CCI chart down here. So whenever the CCI breaks above zero, we enter the trade, and we exit the trade when the moving average 20. This is simple moving average. When the simple moving average 20 starts breaking down. Similarly, we're going to be comparing that against the MACD. So whenever the MACD, that's a black line here, whenever that MACD breaks above zero, we enter the trade, and we use the same exit strategy whenever the moving average 20 starts breaking down. So very similar strategy. Whenever the CCI breaks above zero, we enter. Whenever the MACD breaks above zero, we enter. And we exit both when the moving average 20 breaks below zero. Starts breaking down, I should say. Let's first look at the CCI table of results, and this is based on today's date, and we're collecting all the data back to the start of 2007, as we said. So trading all these shares, these blue chip shares, which is our consistent in our portfolio since the start of the year. These are the amounts generated since 2007. The drawdown for each of these is simply the highest point of profitability on the profitability chart, and at the lowest level it hit. So if you look at the profitability here, for example, that high of profitability there, that was 667, down to that level there. So it fell below our profitability level. So if I drill down to that one, just to give you a better understanding, the drawdown is simply looking at that high point there, coming down to that low point. So it's about 2185, just by drawing that. 2185, this is for Caterpillar. And the drawdown for Caterpillar, you can see there 2702. So obviously it's gone elsewhere. Probably it might have been, if I delete that, if it wasn't that one, it might have been that one. So it depends where the biggest profitability drop was, but that's what that drawdown means. So I've captured the revenue and then also the drawdown. So what we're looking at simply is the drawdown for each of these, and it's simply looking at the drawdown over the 21,000, which is the profitability over the drawdown, which is 185%. That's the CCI logic that I'm using. Enter on the CCI breaking above zero, exit when the moving average 20 breaks below, and had a minimum gain over the last 100 bars of the highs and lows. And we average down when the close is less than the average price. In other words, we're not making a profit, but we enter another lot of shares when the minimum gain is made of the last 100 bars. And it's dropped that much, but also the CCI 14 breaks above zero. So what I want to do now is just go to, say, the start of 2017, to give you an example for both of these trades, comparing the CCI and the MACD. So you can see here, let's talk about the CCI first. So when the CCI breaks above zero, you can see there, we enter their first lot of shares. That's our first $2,000 lot. The price goes against us. You can see there that's kept. We enter another lot of shares there. Now that's very important because the average of the last highs and lows of the last 100 bars, if you look down here, so the average of the last 100 days of the highs and lows is 29.33. So if we draw 29.33, it's about there, 29.87. So we enter when the CCI breaks above zero there. These weren't, they were within that zone, so we haven't entered anymore, and these were also recalculated on every bar. So that's why we enter another lot there. Then we finally exit when the CCI, when the moving average 20 starts breaking down, which it does there. You can see there's a slight red in that moving average 20 line. And also when our minimum profitability is reached. Our minimum profitability is simply looking at that last 100 bars of the average high lows. It's 49.61, 53.79, so you can see there. And that's simply taking that lot there. So about 50, let's say 59. So it's gone above our minimum profitability based on our last 100 bars. So we exit the trade when it goes above that zone there. That's our CCI strategy. The similar strategy is used when the MACD, you can see here it enters when the MACD line breaks above zero. Price goes against us. We enter another lot there. And we exit when our minimum profitability is reached there. Now, let me show you the results of those. This is the CCI results. 39.197. Drawdown is 21.152. So the total profitability of the drawdown is 185%, which is an average of $221 per month on average, just taking that divided by 177 months. That's a CCI program. The MACD program, again for MACD we're using 12, 26 and 9 parameters. We're generating the similar sort of revenue, albeit slightly more than the previous program. And you'll notice also there's a slightly higher drawdown as well. Hence it's giving us a lesser percentage profit over drawdown results. So if you look at the results, this is our summary. I'm simply taking the bottom line for each of those results. So I'm taking these bottom lines for the CCI and the bottom line for the MACD. And that's what this represents. So that's, although that's lower in terms of profitability versus that, that's also a lower drawdown. So as a percentage of profitability over drawdown, that is a better result in terms of usage. The CCI 14 over the MACD 12, 26, 9 approach. So not much of a difference, but just be mindful that you want to have a optimal percentage profit over drawdown to trade with and minimize your drawdown or potential cost of ownership of those shares. That's pretty much it for our summary for CCI and the MACD. Feel free to subscribe, hit the notification bell and the like button. I'll speak to you in a future video.